private AI company become worth $900 billion on the exact same day that the global economy looks like it's bracing for a total collapse?
That is the big question.
Right. Well, welcome to our deep dive into the source material. Today is Friday, May 15th, 2026. I'm Daniel.
And I'm Mira. And yeah, today's tape left a lot of bruises out there.
Oh, severe intraday distribution. I mean, the S&P 500 retreated from its recent record highs to close all the way down near 7,408.50. And at the exact same time, the 10-year Treasury yield violently spiked to 4.595%.
Wow.
Yeah, and gold took an absolute plunge, too, dropping to $4,513.80.
It was an incredibly heavy risk-off session. And what we're doing today is unpacking the how and the why behind that move. We'll break down exactly how an overnight inflation scare in Asia, plus, simmering Middle East tensions, completely hijacked Wall Street's tech-led rally.
Which is wild. But before we get into it, just a quick reminder for you. This deep dive is for market context and discussion only. It's not personal investment advice or an investment recommendation.
Exactly. So session one.
Right, session one. What set the stage before the U.S. session?
To understand today's brutal U.S. sell-off, we actually have to rewind to late last night across the Pacific. Massive inflation shockwaves hit the tape in Asia.
Yeah, let's look at that catalyst. So at 7:50 p.m. Eastern Time yesterday, Japan's domestic corporate goods price index for April came out, and it jumped 4.9% year on year.
Which is a huge spike.
It is. A Bank of Japan official actually noted this was driven by surging costs for chemical products and oil directly tied to the Strait of Hormuz closure.
Right, and it wasn't just Japan.
No. At 5 p.m. Eastern Time yesterday, South Korea saw its export prices surge by 40.8% year on year.
I mean, those are breathtaking leaps. Think of global supply chains like a connected plumbing system.
Okay, a plumbing system.
Right. If water pressure violently spikes in manufacturing hubs like Korea and Japan, those pipes are eventually going to burst in the U.S. You just can't quarantine it. And we really need to name-check weak currency as imported inflation here.
Oh, because of the yen.
Exactly. The yen has been weak, making energy imports catastrophically expensive for Japan. That puts immediate pressure on the Bank of Japan to hike interest rates.
And if they hike rates, that threatens to unwind the global yen carry trade, right?
Yes.
Which, acts like a giant margin call pulling liquidity out of U.S. assets.
Precisely. And speaking of the oil costs driving that Japanese inflation, let's look at the Middle East.
Right. So at 9:28 p.m. Eastern Time yesterday, statements crossed from President Trump. And I want to pause and explicitly state here that we are impartially reporting these political developments.
Right. We're not endorsing any viewpoints, just conveying the source material.
Exactly. So he noted that the U.S. and Iran share a similar view on desired outcomes, like preventing nuclear armament and keeping the strait accessible.
Meanwhile, the Chinese Foreign Ministry urged a ceasefire.
Yeah, and the Iranian foreign minister cited contradictory U.S. messages as a roadblock. So oil reacted strongly, with WTI crude recovering to close today at $101.16.
It's tense.
It really is. And, the media always treats these diplomatic headlines as unpredictable natural disasters. But I have to challenge that reflex.
How so?
We really need to view this through the lens of geopolitical escalation as brinkmanship game theory. It's a calculated exchange of leverage, not just random chaos.
That's a vital framing. State actors operate on logic. And while we're talking about global bottlenecks, we had major chip supply news. At 9:01 p.m. Eastern Time yesterday, Chinese foundry SME noted on an earnings call that foreign clients are shifting orders back to China.
Wait, really? Why?
It's due to AI-driven capacity shortfalls overseas. Plus, at 8:03 p.m. Eastern Time yesterday, USTR Greer noted that chip export controls were actually not the main focus of recent U.S.-China talks.
Which perfectly illustrates physical constraints capping digital growth.
Yeah.
Even if trade tensions cool, the sheer lack of foundry space dictates supply chains.
Absolutely.
So to wrap up, hot Asian inflation and simmering oil risks laid a hawkish trap for the U.S. Open. Let's take a short break. When we come back, session 2, what moved markets during U.S. trading hours? All right, we are back. Session 2. What moved markets during U.S. trading hours?
Well, Daniel, connecting that overnight Asian data directly to the U.S. tape, when inflation fears rise globally, the U.S. bond market takes the hit. And today, That dragged down the entire equity complex.
Yeah, the intraday sell-off was brutal. S&P 500 futures slid from an early high of 7,528.25 down to close near the lows at $7,418.
And volatility spiked.
Oh, big time. The VIX spiked to 19.27 intraday. The U.S. dollar index climbed to 99.27, but credit markets took the real hit. High yield, the HYG, fell to 79.46.
Wow.
And investment grade, LQB, dropped to 107.86.
And a huge driver of that was the Fed holding the line. Markets were digesting late yesterday comments from two key officials.
Right. At 2:53 p.m. Eastern Time yesterday, New York Fed President John Williams stated policy is somewhat tight and there's no imminent need to adjust rates. He highlighted the significant uncertainty around energy prices.
Then at 3:57 p.m. Eastern Time yesterday, Fed Vice Chair Michael Barr warned against easing bank liquidity rules. The Fed is leaning hard on central bank credibility as an inflation anchor.
Yeah, they just refuse to blink on rates or liquidity because of energy prices. But let me challenge this bearish narrative for a second.
Okay, go ahead.
Is the leading explanation of higher for longer just too broad? Like, are we letting macro narratives completely blind us to the underlying micro resilience in U.S. corporates?
I mean, I have to push back there. Look at those widening credit spreads we just talked about. The HYG and LQD drops prove the pain is very real. We're seeing energy shocks as a delayed consumer tax.
Ah, right.
It's finally hitting corporate debt profiles. The buffer is gone.
Okay, that's fair. So surging yields and unyielding Fed speakers basically dominated the trading day. Let's take one more short break.
Next up, Session 3, Corporate Events Recap and What to Watch Next. Welcome back. Session 3, Corporate Events Recap and What to Watch Next. So, while the broader market got battered by macro headwinds today, the private tech sector seems to be operating in an entirely different universe, a very cash-flush one.
Yeah, you're talking about Anthropic. At 8:25 p.m. Eastern Time yesterday, reports broke that the AI startup agreed to terms for a $30 billion fundraising round.
$30 billion. That's astronomical.
It really is. It skyrockets their valuation to a staggering $900 billion. The round is co-led by Dragoneer, Green Oaks, Sequoia Capital, and Altimeter Capital.
It perfectly illustrates AI CapEx as a cycle-agnostic arms race. While bond traders are sweating over a few basis points, these hyperscalers deploy capital at a scale that just ignores the interest rate cycle entirely.
Yeah, it's wild. Also, moving on to some ethics disclosures released at 4:07 p.m. Eastern Time yesterday, President Trump's Q1 2026 financial ethics disclosures revealed at least $220 million in securities transactions.
And that includes holdings linked to major tech firms like Microsoft, Meta, Oracle, and Broadcom. Though we should explicitly note that this story is mainly relevant to a narrower subset of listeners who are focused on tech regulation and government contracting sentiment.
Yes, absolutely. And again, firmly reiterating our impartiality constraint here. We are just reporting the filing data. We are not taking any political sides.
Just providing the source material facts.
Exactly. Well, folks, it was a rough day out there with the S&P 500 sliding and 10-year yields spiking to over 4.59%. It turns out the only thing inflating faster than Japanese wholesale prices is an AI startup's valuation hitting $900 billion.
Right.
Maybe we should just ask Anthropic's AI to figure out how to cut interest rates, since the Fed's John Williams clearly isn't going to do it for us anytime soon.
Good luck with that.
Yeah. And if the AI can't solve our inflation problems, we can always just blame today's market sell-off on that unidentified drone that temporarily shut down Finland's airport overnight. Hang in there, and let's hope tomorrow's portfolio doesn't require its own cyber defense alliance to survive.
Seriously. Well, looking ahead, here's the docket for Monday, May 18. At 8:30 a.m. Eastern Time, the Atlanta Fed Financial Markets Conference opens.
Also at 8:30 a.m. Eastern Time, we get the New York Empire State Services Business Activity Index.
At 10 a.m. Eastern Time, the NAHB Housing Market Index.
Then at 11:30 a.m. Eastern Time, we have the 13-month and 26-week Treasury bill auctions, which is a key front-end rates test.
And finally, at 4 p.m. Eastern Time, the net long-term ticky flows.
Awesome. So as we wrap up, I want to leave you with a final thought to mull over. If a $900 billion private AI valuation can happen on the exact same day that bond markets are pricing in a severe global liquidity squeeze, you have to ask yourself, are we looking at one economy right now or two completely different ones operating in parallel?
Let us know which economy your portfolio is living in by sharing your thoughts in the comments below.